The number one way to best navigate the high interest rate environment. Don't panic. Don't do something rash just because you read an article this morning that talked about how crazy interest rates are right now and how the world is going to come to an end because of it. In news broadcasting, there is a saying, if it bleeds, it leads. Essentially, stories involving horrific incidents catch people's attention, and that attention brings in more readers and viewers, which in turn enables news companies to make more money from ads. Now, a story regarding high interest rates may not directly involve violence and death. However, they can solicit powerful emotions from people. Fear, despair, helplessness. What if the rates keep going up? Can I ever buy a house? What if I can't even afford food for the family? But step back and recognize that the world is not coming to an end. The world isn't falling apart. You have a lot more control than you give yourself credit for. And while it is good to read news to keep ourselves informed of what is happening in the world, read it with a grain of salt. It doesn't reflect the whole picture and at times even reality. Yes, are rising interest rates somewhat concerning? Sort of. However, when we wind the clock back, rising interest rates are nothing new. Yes, if you're in your 20s and 30s and you grew up in a low interest rate environment pretty much your whole life, you could be a bit rattled by the current interest rates. Average auto loan around 9%, average 30-year mortgage rate around 7%. Compared to what they were just a couple years ago, you might feel like you want to throw in the towel. Or even worse, temptation to do something rash like sell all your stocks and dump them into a high-yield savings account. Or buy a bunch of gold because you heard from a friend that gold is always a good investment no matter what the economy is doing. But don't do things based on emotion. Don't panic. Don't act rash. Ground yourself. But how? Which leads to the next way to best navigate the high interest rate environment. The number two way to best navigate the high interest rate environment. Understand the cycles. When we hear about the rising interest rates, the first question that many of us ask is this: why is the Fed tinkering with the interest rate? Or on the second thought, what does Jerome Powell actually have to do with interest rates anyways? All good questions, and actually a better way to respond to high interest rates compared to panic. Being curious. The Federal Reserve, the nation's central bank's key role in the government, is to keep the economy stable for the American people. And one of the ways it does this is by monitoring the inflation level. Though inflation is under better control now, hovering around 3%, just a couple years ago it was as high as 9%. If you can recall, some highly consumed items like meat and bread were 10 or 20% more expensive. So in order to manage the high interest rate, the Federal Reserve uses interest rate as a mechanism to control inflation. The Fed raises or lowers its benchmark rate, known as the federal fund rate, and this influences how much banks and other financial institutions pay to borrow, which in turn influences how much businesses and households can borrow. In general, lower rates help stimulate the economy by making it cheaper for businesses and households to borrow money. The Fed did this following the housing crisis in 2007 and 2008. It did it again in 2020 during the COVID-19 pandemic to a record level of near 0%. Higher rates do the opposite and are designed to slow the economy by dampening consumer demand, and in turn, ideally help to curb inflation. Less demand, lower the price. The Fed hiked the rates in 2005 to 2006 to cool off the economy and the growing real estate bubble. And since 2022, the Federal Reserve had been incrementally increasing interest rates in order to help curb inflation, which so far looks like it has worked. As I stated earlier, inflation is now hovering around 3%. The average annual inflation rate based on the past 30 years is around 2.5%. So we're pretty close to where we were before. However, while higher interest rates can help with managing high inflation, as I alluded to earlier, it makes it harder for companies and individuals to borrow money because borrowing becomes more expensive. Thus, people can feel dejected with their current situation because it's more expensive to buy a car, buy a home, or anything else that requires debt. However, a high interest rate doesn't mean it's all bad news. As with anything in life, while some people may only see negatives with certain situations, some smart individuals like yourself see opportunities. Which is why I'm excited to talk to you about today's video sponsor, Fundrise Flagship Fund. As I just talked about in this video, when interest rates are high, the real estate market takes a big hit. Mortgages are expensive and home prices stagnate or drop as a result. But if you think like an investor, while others see a down market, you see opportunities. As Warren Buffett has said, be fearful when others are greedy and be greedy when others are fearful. And the Fundrise Flagship Fund, with its long-term view, is designed to take advantage of this macro trend. The Fundrise Flagship Fund is a well-diversified real estate fund that holds $1+ billion real estate properties, including 4,700 single-family rentals that they built from ground up to rent. It incorporates Fundrise's most favored real estate investment strategies, all in a single portfolio with focus on the Sun Belt states. And by focusing on these regions, the fund stands to benefit from the demographic shifts and job growth in this region while maintaining the ability to pivot quickly to take advantage of shifting market conditions. The flagship fund is planned to take advantage of this down market while it lasts by aggressively expanding its $1+ billion private real estate portfolio and investing millions of dollars over the coming years. For investors, this means a chance to get in at a time when prices are likely discounted due to high interest rates. So if you've been thinking about ways to diversify your wealth beyond stocks and gain greater exposure to real estate, you can check out the Fundrise Flagship Fund. Not only is now a great time to buy because of high interest rates, you don't need a lot to get started. With a $10 minimum, the flagship fund makes it easy for investors of virtually every size to invest in institutional quality real estate at the touch of a button. If you skip eating out for lunch tomorrow, you can be an investor too. That is enough to get you started. So make sure to use my special link I'll have in the description below and get started today. Alright, with that said, let's get back to the video. The number 3 best way to navigate the high interest rate environment. In the line of taking advantage of certain circumstances, take advantage of high yield savings accounts. In general, while a high interest rate environment is tough for borrowers, it is great for savers. Now, if you watch any of my other videos, you know I love holding cash. Normally, they don't provide great financial returns, but they pay in other ways. For me, it gives me a mental and emotional peace. Knowing that I have enough financial runway in my bank account, I can make the best financial decision without feeling rushed and pressured. And for the past decade, it was almost impossible to earn more than 0.01% interest rate on your cash, given how low the interest rates were. However, during times of high interest rate, you can find places where your cash can earn a higher interest rate, almost like having your cake and eating it too. So check with your current bank to see what high yield savings accounts are available. If you're not married to your current bank and are willing to move some money around, there are many other options available. I've seen many banks offer as high as 5% in annual percentage yield. Again, just a few years ago, you would have been hard-pressed to find an account with even 1/10 at an interest. So if you have some liquid cash sitting around not earning much in interest, take advantage of this high interest rate environment and earn more through a high yield savings account. The number 4 way to best navigate the high interest rate environment. In the line of taking advantage of high interest rate accounts, take advantage of high interest certificate of deposit, aka CD. A certificate of deposit is a type of savings account similar to a high-yield savings account. However, the one key difference is that you have to agree to keep your money in the account for a specified length of time. These usually range from 3 months to 5 years, but they can be as short as 1 month to as long as 10 years. And if you decide to withdraw your money before the end of the specified length of time, you will need to pay a penalty. Now, the choice between a high-yield savings account versus a certificate of deposit is personal, but generally comes down to the interest rate and the liquidity requirement of your money. Do you need easy access to your money? Or can you tie it up for several months because you have other means to cover emergencies? Most often, if you have a specific savings goal that is 1, 2, or 3 years out, and you don't need the money until then, that could be a good candidate for a certificate of deposit. Also, certificate of deposit locks in a rate for a term period, which makes what you're going to get for your money more predictable, whereas high-yield savings account interest rates can change at any time. A quick reminder before we move on to the next way, make sure to download your free 1-page PDF companion guide that goes along with this video. It has everything I'm covering in a simple to digest 1-page format. So go to the link I'll have in the description below to download your free copy. The number 5 way to best navigate the high interest rate environment. If you have high interest rate debt, prioritize paying it off. High interest debt is a never good thing, but in a high interest rate environment, it can be detrimental. According to the Federal Reserve Bank of New York, the total credit card balance in the United States is over $1 trillion, and student loans are closing in on $2 trillion at $1.6 trillion as of fourth quarter of 2023, both record high numbers. For credit cards where the interest rates vary, higher interest rates drive higher annual percentage rates or APR, making it even more costly to carry debt. According to LendingTree, the average APR on credit card interest rate right now is around 25%. Just a couple years ago, it was way below 20%. I don't know about you, but these numbers terrify me. And in a high interest rate environment, it should terrify you as well if you have high interest debt that you're carrying around month to month. If you don't get your high interest debt under control, it won't matter what else you're doing with your finances. This fire can and will consume other parts of your financial home. So if you have high interest debt, prioritize paying it off as soon as possible. List out all your debt and create a plan for getting rid of them. You can choose either the debt snowball method or the avalanche method. The method doesn't matter. Just choose the one that best motivates you and go with it. The number 6 way to best navigate the high interest rate environment. Once you worked hard to pay off all your high interest debt, be wary of borrowing any more money. In layman's terms, stop borrowing money. To be honest, this isn't advice I would give regardless of how the interest rate is doing, but it is especially more dangerous when interest rates are high. If you watch any of my other videos, I often talk about the power of compounding, how compounding over time can multiply our investments and really grow our net worth. However, this only works when compounding is working for us, not against us. When we're paying interest on debt that we owe, our money is compounding for somebody else. Let's look at this reverse compounding when it comes to credit card debt. Let's say that you had an amazing week in Cancun over spring break and you racked up $20,000 in credit card debt. As I stated earlier, the average interest rate on credit card debt today is around 20%. If you were to only pay the minimum, how long do you think it will take to fully pay off the credit card debt? At a 2% minimum payment percentage, it would take you a little over 9 years to completely pay off the $20,000 in credit card debt. However, what is worse is the total interest you would have paid to the credit card company. $23,000. Now remember, the original credit card debt was $20,000. You essentially gave the credit card company an additional $23,000 for the privilege of using their credit card. Debt is bad, but credit card debt is just horrendous. Trying to build wealth with credit card debt is like trying to run uphill with a bag of rocks on your back while dragging a dead horse at the same time. We might have had a nice Cancun vacation, but was it really worth an additional $23,000? Probably not. The number 7 way to best navigate the high interest rate environment. But let's say that you do want to borrow responsibly to buy a house. My recommendation is to do it from a place of strong positioning. This is especially important in a high interest rate environment. What do I mean by positioning? Let me explain. The greatest invisible aid to life and money success starts with the right positioning. When you're properly positioned, there are so many different paths to achieving success. However, if you're poorly positioned, your options are very limited. Let's say that you buy a house with a 7% interest rate with the hopes that the interest rate will fall in the near future. Your thought is that when the interest rate falls, because that's what everyone else is saying, you can refinance. And with this reasoning, you take on a home mortgage that is a stretch for you. You don't have enough to save and invest. Everything is going towards your home mortgage. And you think that this is okay because the interest rate will fall. But what happens if the interest rate doesn't fall or take much longer than you hoped? The truth is that we have no idea when the interest rates will go down. Yes, there are cycles, but to know exactly how it will pan out is like trying to read a fortune cookie. So my thought is this. If you're wanting to buy a house, always do it from a place of strong positioning. If you can buy a home right now with the current interest rate and you feel comfortable with those payments, go right ahead. Then if the interest rate increases for whatever reason in the near future, then it doesn't impact you. You already got yourself a great interest rate. But let's say that the interest rate drops. Great. You can take advantage of that lower interest rate and refinance. Win-win whatever the scenario because you positioned yourself well. Some people will say homes are too expensive right now. Others will say the interest rate will drop this year. The truth is, no one really knows. So if you want to buy a home, do it from a place of strong positioning where you win whatever the future scenario. Bottom line, if you're really stretching your budget to make the 7% interest rate mortgage work for you, it may be time to step back a little and rethink that purchase. The number 8 way to best navigate the high interest rate environment. Diversify your investments. There are economic principles that theorize how high interest rate affects different types of investments. For example, high interest rates affect earnings and stock prices because of the high cost of borrowing for companies. But the market currently is at the highest it's ever been. In 2024 alone, the S&P 500 hit its all-time high multiple times. According to talking heads, we were supposed to be entering a recession. So what happened? This is another example that shows market forecasters have no idea. Forecasts may tell you a great deal about the forecaster, but they tell you nothing about the future. So the best strategy to give our mind some peace as well as mitigate our risk is to diversify as much as possible. If you're investing in a total market or a S&P 500 index fund, you're already pretty well diversified. But if you want to diversify even more, consider real estate, international index funds, or bonds in your portfolio. Number 9 way to best navigate the high interest rate environment. Work to maximize your credit score. You and I can't do much about the Fed and the interest rate. If they want to raise the interest rate, so be it. We can complain all day long, but that is the reality of living in today's world. However, we can do something about our credit score. That is within our control. Outside the Fed, personal credit score has the greatest impact on our ability to borrow money at the best current rate. Financial companies will save the lowest rates for their best customers because they know that they'll pay back money borrowed on time and in full. And a good to excellent credit score is the best indicator to identify who the safest and best borrowers are. To have the best credit score possible, I recommend concentrating on these 2 factors. Making all your debt payment on time and keeping your credit utilization ratio as low as possible. These 2 factors have the biggest influence on how your score is calculated. A simple strategy to keep credit utilization ratio low is to call up the credit card company and request an increase in your credit limit. If you have a history of making your payments on time and have a great credit score, this should be an easy request for the company. And just a note, just because you have an excellent credit score doesn't mean you have the permission to go out and borrow more money. You always want to be cautious about taking on more debt, especially in a high interest rate environment. Maintain your excellent credit score in case you want to borrow, but also check yourself from getting into more high interest debt. The number 10 way to best navigate the high interest rate environment. Don't get swayed by the market volatility. Ignore market volatility and stick with your long-term investment strategy. Buy and hold, and then buy some more. As I mentioned earlier, when Fed raises interest rates, this in turn raises borrowing costs. And when borrowing costs go up, it has a ripple effect of tapering growth and consequently fueling market volatility as companies are trying to navigate the market uncertainty. Though the market is at its peak right now, for the past couple of years while the Fed has been ramping up interest rates, the market was rocky. It had its fair share of ups and downs, and this could happen again pretty soon. A market dip could be right around the corner. However, if you're a long-term buy and hold investor, this shouldn't mean anything. You have decades ahead of you, and these market volatility are just a blip in your long-term investing journey. Just take a look at a chart of the S&P 500 in the last 100 years. We had similar high interest rate environment in the past, but if you have confidence in the American economy, the trend is and will be up. Bottom line, the high interest rate environment can feel nerve-wracking, but only if we allow it to. Understand that it has happened in the past, and we will likely see more of it in the future. Practice timeless money and investing principles, and there's a good chance you'll come out the other end stronger. Thank you guys for watching. In the line of investments, if you'd like to learn more about some most popular investments and how they compare to each other, check out my video here. Until next time, all the best.